Let me ask you something very simple. When was the last time buyers claimed?
Let's start with what actually happened, because the headlines made it confusing. The Federal Reserve is America's central bank. It controls a key interest rate called the federal funds rate. And when that rate goes up or down, it affects everything. Your mortgage, your car loan, your credit card, your savings account. The Fed kept the federal funds rate unchanged at the 3.5% to 3.75% target range for a third consecutive meeting in April 2026. The decision was not unanimous, with 4 officials dissenting, marking the first time since October 1992 that 4 officials dissented against an FOMC decision. IO Fund, 4 officials disagreeing inside the Fed itself. That is not normal. That tells you something very important. Even the experts don't agree on what to do next. And when experts disagree, regular Americans pay the price. Now let's talk about your actual mortgage payment in real numbers. The average rate for a 30-year fixed-rate mortgage now sits at 6.23% as of April 2026, according to Freddie Mac. For a 15-year term, you're looking at 5.58%. The motley fool, for the third time this year, the central bank kept its federal funds rate untouched, and that all but ensures that interest rates offered by lenders will remain elevated. U.S. Bank, now here is what that means in dollars and cents. If you have a $300,000 mortgage at 6.23%, your monthly payment is roughly $1,850 per month, just in interest and principal. That is over $22,000 a year going straight to the bank. If rates had dropped to 5%, that same payment would be around $1,610, a difference of $240 every single month. That is nearly $3,000 a year back in your pocket. But right now, that money is staying with the lender. Now here is the part that nobody on the news is talking about loudly enough, and it is serious. Some Fed officials favored a framing that highlighted additional increases could be warranted if inflation persists above target levels. The vast majority of participants judged that upside risks to inflation were elevated, and that a prolonged conflict in the Middle East would likely lead to more persistent increases in energy prices, which would pass through to core inflation. IO Fund, in plain English, the Fed is not just refusing to cut rates. Some officials are talking about raising them again. A pause is still better than another interest rate hike, especially considering the recent surge in inflation. U.S. Bank, but that hike is now back on the table, and if it happens, your mortgage rate, your car payment, your credit card interest all go higher. So who really suffers when the Fed keeps rates high? Let me be direct with you. If you already own your home with a fixed-rate mortgage, you are protected for now. Your rate does not change. But if you have an adjustable-rate mortgage, a home equity line of credit, or a HELOC, your payment can go up every single time the Fed moves. Rate cuts affect adjustable-rate mortgages directly, since their interest rates fluctuate with the broader economy. That includes RMS, credit cards, and home equity lines of credit. Seeking Alpha, the median monthly payment applied for by mortgage borrowers was $2,131 in March 2026. Seeking Alpha, over $2,000 a month just for housing. For a retired American on a fixed income, that number is brutal, and it is not going down anytime soon. Here is something else that very few people are talking about. A big change is coming at the Federal Reserve itself. The Justice Department said it would halt its criminal investigation into Powell, removing a key obstacle to the Senate's confirmation of his nominated successor, Kevin Warsh, whose appointment is set for May 15. IO Fund, a brand new Fed chair, new leadership, new decisions, and nobody knows exactly what direction Kevin Warsh will take. The Fed may adopt a more aggressive strategy this year than it did in 2025, in part because a new chairperson will take over this summer. Seeking Alpha more aggressive could mean higher rates. It could mean tougher rules for lenders. It could mean your mortgage situation gets harder before it gets easier. This is not a time to look away. This is a time to pay close attention. All right, you have heard the problem. Now let's talk about what you can actually do starting this week. Smart move number 1. If you have an adjustable-rate mortgage or a HELOC, call your lender this week. Ask them exactly what happens to your payment if rates go up by 0.5%. Know your number. Do not be surprised. Smart move number 2. Borrowers should understand that mortgage rates are most likely to remain steady for the time being, which means more time to shop around for rates and lenders as they look to other drivers to adjust their offers. U.S. Bank used this window to compare lenders. Even a small rate difference saves thousands over the life of a loan. Smart move number 3. Whether you're buying your first home, considering a refinance, or simply watching the market, understanding how Federal Reserve policy affects interest rates can help you make informed financial decisions. The Motley Fool bottom line: the Fed is not your friend right now, but you can still protect yourself. Stay informed, ask questions, and do not let Washington's decisions catch your family off guard.